morning, good afternoon, and good evening to everybody out there. We're back here for another episode of Between Bears and Bulls. My name is Angel Vásquez. As always, I am joined today by our expert in finances, Yinka and Angel. Yinka, how are you doing today?
Pleasure. I'm doing great. Pleasure to be here.
Great to have you, man. Today, we'll be covering risk and reward. Today, we're going to be talking about balancing investments for long-term success. We will be discussing how to build your own portfolio, how to select a few things, and we're going to discuss the investment minds or the psychology behind an investing mind for young people and for older people. So, Yinka, to kick this off, if we can start off with a short explanation about understanding risks and rewards when it comes to investments, and as a follow-up, if you could explain quickly what's a return on investment.
Yeah, that's a good way to kick off. We talk about risk and reward. I'll convert that to risk and return. And it's a very simple formula. And whenever people stray away from the formula, they get in trouble. The formula says, the higher the risk, the higher the reward. The lower the risk, the lower the reward, which is the returns, right?
Okay.
Essentially, the reward is the returns. Higher risk, higher returns. Lower risk, lower returns. Whenever people are trying to accomplish high returns with low risk, they end up getting into scenarios of victims of fraud because it sounds too good to be true. And I think we've heard that before. So whenever you put in money into investment vehicles or taking advantage of investment opportunities, if somebody tells you you can make an extraordinary large rewards, but they're explaining something that has very little risk to you, that should be a red flag. Give me X amount of dollars. I'm going to invest it in this real estate strategy for you. And in 6 months, I could double your money. That is low risk, high returns, red flag. So your ROI is driven by your risk.
Interesting. Good to know. So to that, I want to ask, can we define a few types of risk? Because I like the example you just gave, the real estate example. But real estate itself is one market. Yes. But real estate, I'm aware also, it's not the most liquid per se, the most liquid asset to hold.
Absolutely.
And on top of that, I know, for a lot of people, oftentimes they buy real estate, but on credit.
Right.
So if we can discuss quickly those three sectors, you have the market risk that it brings, you have the credit risk, and you have the liquidity risk.
Yeah. So we start with the market risk, right? For a lot of investment assets, the market risk essentially is what's happening around the external component of the company, which is the market relative to the business itself. Because we know, as we all know, changes in market conditions affects prices, right? So if you're investing in something that the price could be affected by market conditions, which is almost every investment vehicle, right? Most investment vehicles, at least. You have to be aware of market conditions because your market risk is one thing that you could try to diversify because you could spread across different types of industries, different types of products, different types of sizes of corporations to try as much as possible, as much as you can, to reduce your market risk. That's one of the areas of opportunity when you talk about asset allocation. And, credit risk, we could see credit risk from two sides, right? Credit risk is the next one. You see credit risk from two sides. Credit risk is really your, essentially the ability and willingness for people to pay their debts, right? And, people say, what do you mean by that? What do you mean the willingness? I thought it was only the ability that matters, right? But the willingness matters. And there's an example that we typically use, a well-documented example. During the real estate market collapse in 2008, there came a point in time where even people who had the ability to pay their debt refused to pay their debt because the value of their houses was less than the value of the debt. So like, you know what? I'm just going to let it go in foreclosure. That's ability. So you have the ability, but that's the willingness that you say, no, I'm not going to pay it. I'll just give it back to the bank and I'll walk away. And so as an individual, you don't tend to worry too much about credit risk. The credit risk is normally borne by the institutions, right? Unless you're lending people money, right? or you're in bonds and things that are debt, securities, like, because that's when credit worthiness comes in play. If you're buying government bonds, how good is government? Because buying a government bond from the U.S. is different from buying a government bond from some small country. And, I'm not going to mention any country. I don't want to offend anybody, but you get the idea.
Yes.
So you're measuring from that standpoint when you're holding debt securities. But the institutions have to worry a lot about credit risk. And how do they do that? They check your credit worthiness. And we talked about credit last time. They check your credit score. They check your background. They check, how good you've been with debt. They check if you filed for bankruptcy. Because they themselves have to reduce credit risk, right? They don't want to give, first of all, they don't want to give credit to somebody who is going to be majority of their portfolio. Like, I'm not going to have all my eggs in one basket as an institution. And so they have to reduce that. Also, how do they do it? In addition to that, they ask for more collateral, right? Because that reduces the chances of you disappearing because there's a collateral.
Yes.
And so they've, and obviously we know about credit score, and they check your credit score, they check your income. They've done different things to make sure your ability and your willingness to pay the debt could be identified and could be structured in a way where the institution is not taking too much risk. And you said liquidity. Liquidity also goes on both sides. Because liquidity, we talked about liquidity also in the previous episode, and liquidity is really, at the end of the day, your ability to have cash on hand for either future goals or unforeseen events. Sometimes it's short-term planned goals. But liquidity, again, from an individual and from an institution, it matters. If you're someone who wants to save up money to buy a car, you probably have a 2-year time horizon, and you can't probably invest in a 10-year bond.
Of course.
It's going to affect your liquidity, because what you don't want to do is invest in things that's going to increase the cost when it's time to convert to cash. And so liquidity risk is borne by you. Institutions also have liquidity risk, because if I'm an insurance company, right, I can't put all my assets into some fixed long-term illiquid asset. Because if I'm insurance, I'm going to have to pay a few claims, right? I need to have the liquidity to pay the claims. And we saw what happens when banks don't have
we have
liquidity, right? Especially when you get a bank rush. I think you've seen what happens. Banks literally disappear from that. That's a liquidity problem. So both people and institutions often have to balance and measure liquidity risk, because it really determines how you outlay your cash, how you execute your goals, and also how you manage your time horizon. I think those things are part of the mix. It's not an easy straight line concept. There's a lot of factors that play into it. As long as you identify those factors, and you can make better decisions around liquidity risk. We do it every day.
And I like that you explained liquidity like that, the ability to have cash on hand or available. Because it reminds me of a thing I learned in a class. I believe it was one of the first classes I took here at Atlantis University, a supply chain management class, where one of the topics we had covered was, back in the 1900s, the change from, I think it was just in case to just in time.
Yes.
Right. We had good old Henry Ford create I forgot what it was, but it was a manufacturing process, I believe it was.
Yes.
And it really changed the way businesses worked, because with just in case, they had their assets, they had a lot of money just tied up into these physical components that they weren't very liquid. They couldn't get rid of them, just quick as is. But in modern days, we've seen with a lot of companies, and this was really, really highlighted during COVID, was a lot of companies they have it just in time, which for our audience out there, just in time means as quickly as it's produced, it's gone out and it's shipped to whoever ordered the product. So it's a good thing to put it like that.
Yes.
Yinka, of course.
And I think people talk about liquidity risk from an individual. I think one of the things that we've seen in the last few months are very high-profile people selling their shares in companies.
Oh yes.
Jeff Bezos, Elon, I believe for the first time, the CEO of Chase also sold some shares for the first time.
Jamie Dimon.
So he was like, "Well, what's happening? What did they?" You know, people make it almost seem like it's some nebulous thing like something is happening, but really they want to have some more liquidity because they probably have a plan to acquire something. Right, that's what that is. You sell so you can have liquid cash because you know you need the cash when you want to execute.
Oh yes. It's a good thing to point out. Yes. You know, now Yinka, I wanna talk a little bit about I'd like to explain a little bit, or if you can explain to us, time horizons and risk tolerance, and to add on to that, factoring how age and financial situations, as well as risk personality and risk tolerance, affect these matters. Because I can kind of imagine from experience and from what I've seen, when you're young, you're impatient, right? If you're going to go into investing, you want money, but you want it immediately, right? But when you're older, you don't really think about, I want money immediately. You're thinking of more long-term goals.
Right.
So we can discuss right quick those topics.
There's a very popular saying that investing is for asset conservation, not getting rich. I think that could be the poster board of this conversation. Investment sometimes is marketed as some way to get very rich very quickly. But when you look at the sample size of people who've actually gotten rich very quickly, it's a very tiny sample size. So mathematically, being realistic, that's not the intention of people who invest. At least it shouldn't be the intention, right? Maybe they have some ideas that are grandiose, but you're trying to conserve your resources, protect your resources, protect your assets, not to just scale 2,000% in 1 year. It's impossible. So time horizon plays different roles, especially when it comes to your goals, because that's where time horizon really factors in, right? When it comes to your goal, because my goal as a young individual may be things like buying a car, buying a house, saving for a wedding, and some other person who's twice my age, their goal is to continue to fund their retirement, right? So, and then yours as a college student is probably going to even be very much more open to risk, right? Your risk tolerance will be a little bit different from mine because you have more time, right? I don't have more time. And the guy that's 80 has less time. So he wants to make sure he has enough. So that affects our risk tolerance and how we determine the types of investment we make. You could take more risk. You could buy some risky stocks. You could buy some cryptocurrency where I can't. Maybe your asset allocation, maybe you want to put more into cryptocurrency. And I was like, listen, I'm not too far from retirement. I can't take that risk if crypto disappears. But if you lose it all, you could probably regain some of your assets over time where I can't. So time horizon is very critical for the individual. But like I said, for the institutions, time horizon matters too on how they invest, because if they have to pay out claims, they have to say, okay, we need to have a certain number of asset that should be liquid because we need to pay out claims. So you determine how you want to invest. You determine how you look at the risk. And, main thing here is just like we talked about credit risk. Risk tolerance, your ability to take risk, your willingness to take risk.
Okay.
Very different things. You could be very willing to take risk. Some people don't care. But do you have the ability to? Do you have the resources? Do you have the backup? Do you have the cash? Do you have the liquidity in case something goes wrong? You put all your money into one asset class. What if that goes wrong? Do you have the ability to? And you notice, in investing, they normally ask you a lot of questions. Even when you're buying a house, they ask you a bunch of questions. They're trying to even assess your net worth because they don't want you getting multiple loans from different people because it's going to affect your ability to take risk. And so those are the things that we ourselves could predetermine for us. Like we could look at ourselves before we make an investment, we could determine, okay, this is my willingness to take risk. What is my ability to take risk? That's when you start looking at your liquidity, your assets, your time horizon. That's what you do in that bracket. So, people should definitely keep that in mind. Time horizon, your liquidity when you're trying to make strategic investment decisions. especially depending on your age, it matters. Time horizon plays a huge part, on how you how you place your bets. Let me call it bets for now. How you place your bets depending on your age. Yeah. So that's how it looks.
No, and it's a good way to place, because I believe by now I think it's already been 2 previous episodes, you've mentioned 2 terminologies: risk appetite and risk tolerance.
Yes.
Right? And what you were basically just told me is, when you're younger, you might be a little more willing. You might have the risk appetite, and you might have you might have the risk appetite, but you probably don't have the risk tolerance for it.
Right. Which is what I'm saying now is that your willingness to take risks versus your ability to take risks, right? You have to, again, we could go into classes and ask people, hey, how much do you have in your pocket? $100. Would you like to invest $100 in this new thing that I have? They're like, okay. So they have a kind of high ability in their mind, at least. But when you really go through the process, assess the process of the ability to take risk. How much do you have total in your bank account? Do you have enough liquidity that if you give me this $100, that your life may be impacted if I lose it all, right? So, and then you're like, what other assets do you have? What's the time horizon that you're going to need this $100? Your ability. Your ability is really, really important. We don't talk about it enough. I think in investing, we should talk a lot about ability, because a lot of people have the willingness to take risks.
Yes.
You have the willingness. Yes, I'm ready. Yes. I want to give you my money because you tell me I could double it, but you have the ability to take risks. That's where that comes in.
I've seen that so much with people in my age range, in my generation, that because we're bombarded a lot with these gurus of investing, of crypto investing, stock market investing, and all these how to get rich quick.
Yep.
I don't know if the word schemes would be correct, but
that would be correct.
All these how to get rich quick schemes, and we hear it, and to us it's like, okay, we're just getting out there into the world, right? We're just recently gaining the ability to have our own money, and now you're telling us, my goodness, we can make way more money and not have to worry about, I didn't have the $2,500 for my rent this month.
Right. And so you say, take my money.
Exactly.
And then you find out, because again, when you're young, your attitude towards risk is very different from when you're older. I'm sure almost everybody in this campus will be very, very eager to place their money into very risky investments. But if you went into a corporate building that has people between the age of 40 and 50, they're going to be a little bit
skeptical.
Less, yeah, they're like, wait. I'm not that interested, because I know there's a risk here that I need to assess, and my ability to take the risk.
No, it's good to mention that. Now, I do have a question, because now that we've discussed, so risk appetite, we just discussed it, right? We just discussed the risk tolerance, and the difference between how old you are and your time horizons and so forth. How do you build a balanced portfolio? Because I know, or I imagine, you can't be everywhere at the same time. Right? You can't invest into everything at the same time, especially when you don't have the financial resources for that.
Right.
If you have the financial resources, if you're a massive fund, then hey, you have money to kind of play around with, and you can diverge into multiple markets. Right. But when you're just getting into it, or if you're just a very small firm, you don't exactly have that cash on hand to put into the real estate markets, or to put into stocks,
exactly,
or to put into commodities, so forth. So how do you build a balanced portfolio?
That is a very good question. The answers take multiple routes, right? Either from an individual or from an institution. From an individual, I know, you take a step back, me, I did term 60-40 portfolio. Okay, 60-40, 60% stocks and 40% bonds. But even in that, what type of stocks are they? What industry? What's the mix in that 60? Not that 60-40 is for everyone, because it's a high-level generic number split. But invest in asset allocation in reality should be customized to the individual. Look at everything we talked about: liquidity, time horizon. You have to consider what this person is going to do with this asset. right? You know, you have to consider the person's preferences and their risk. So when we think about it that way, how you invest matters, and how you allocate assets matters. Now, what I would say is, without you knowing anything, one thing we all agree on is that you have to diversify. You know, whether you have a short time horizon, long time, diversification is the key. But again, diversification may change based on your risk tolerance, right? You know, someone could put all their money into cryptocurrency where I can't, right? So the goal is to diversify and have a very good mix of different types of assets, from bonds to stocks and even some non-traditional vehicles, right? Because you see people after a certain net worth, they start taking a little bit of the portfolio and put it into a little bit more riskier investments, right? You know, venture capital and so on and so forth. But again, that's based on the individual. Where they could put 10% of their total assets into venture capital, I may not be able to do so. So I think the idea is to construct an allocation that really meets your needs based on your preferences of risk, your liquidity preferences, your time horizon. Consider all those things. And by the way, at the end of the day, individuals don't have to do this. I know some people like to do this, but individuals do not have to do this, because the institutions and the experts could do it for you at a probably lower cost in passive investments, right? You know, we talked a lot about ETFs, we talked about different tools, talked about index funds. So think about it. It could be done for you, but as an individual, your goal, your responsibility is to understand your risk tolerance, is to understand what's your time horizon. Once you get that in place, you can make better decisions around how you allocate assets. I mean, that's what we all do every day, right? You take your paycheck and then you start buying things and you figure out. We do it every day. We do it every month, at least with that plan, right? You have to have a very good asset allocation strategy. And it gets more technical on the institutional side, because they have to have a well-structured mechanism to allocate assets. And once in a while, they have to restructure those allocations, right? It won't stay the same forever, because they also have to react to all the things we talked about: credit risk, market risk. They have to move your money around. They have to make decisions to make sure that you're not overly exposed into one industry, overly exposed into one type of business. That's what they do. But as institutions, they have more responsibility on asset allocation. I'm not sure that individuals should be born with that risk of consistently allocating their asset, moving things around. I think that's probably better left to the experts, because they could react probably quicker than we can, to be honest with you.
You know, I like that you mentioned, so there are a few things you mentioned right there, right? So one is individual investors, or individuals in general, leaving it to the experts. Because, you know, when you're an individual person and you want to start investing, oftentimes you're skeptical about investing itself. And when you hear there are, you know, companies that are willing to invest for you, you look at it a little more skeptically too, because you're like, well, how much money do I have to give them to get started first off? Because if I don't have that money on hand, then that's an issue for me. And on top of that, how do I even know that this company, this firm that says they're going to invest for me,
they're not going to run up with your money?
Exactly.
That definitely is going to be an important due diligence that each person has to do. Just don't give your money to anyone and everybody who says they can invest it for you. You have to do your due diligence. Luckily for us, in this modern era, there's credible sources of investment. There's credible institutions that have been around for hundreds of years. Not saying they're the best, but clearly we have a choice now, right? We don't have to get a phone call from our neighbor and say, hey, I got this real, very profitable plan. You would like to chip in $2,000? We don't have to do that anymore. We could literally just look for the right institutions and invest money. So in my concept of individual people not being too bogged down by the idea of complex asset allocation, portfolio construction, I think those things could be delegated to experts who could do it for even a lower cost. Now let's think about this statistically, and I'll close out with this, which is very important, because in this era, we've had a high number of aspiring day traders.
Yes.
Right?
Yes.
Because they believe they know how to construct the best portfolio that will make the best returns, and they could react very quickly to market conditions, market changes. 90% of day traders do not beat the indices.
Yes.
What does that tell you? Active investing is costly, but you also may not win 90% of the time. That's what that tells me. Now, everyone could have their own interpretation of what that means, but it supports the idea that you don't have to be an active investor. You don't have to be the one constantly managing your asset allocation, constantly figuring out your portfolio construction. I think those things could obviously be delegated. In a modern era, it's very easy to delegate because 90% of the time, you're not beating the market returns. You're not beating the S&P 500. So what are you doing? It's like running on a treadmill. Yeah, you're running and working out, but you're not going anywhere. So that's my take.
And now with all this that we've just covered, to kind of wrap this up, because it's a lot of information to take in. We don't want to bore the viewers to death with all the lingo and all the technical talk. The brief summary from what I'm understanding is, so we have to understand that whatever we invest, if it has a high risk, it can have a high reward. If it has a low risk, it's going to have a low reward. But if there's a disparity between it having a high risk but a low reward, or a low risk and a high reward, then there's something shady happening around there.
Red flag. Yeah, it's a red flag. Now we don't know if it's criminal activity or we don't know if it's incompetence, right? But we know it's a red flag, and it's up to you as an individual to troubleshoot what that means for you, right? At the end of the day, if those things are skewed, if that thing goes in the opposite upside down, where it's high reward, low risk, I'm like, okay, wait a minute, or high returns, low risk, then that tells me something is more interesting here that I need to look into, right? Because I don't know if the person talking to me about this opportunity is just incompetent or they have some ulterior motives that may be negative, right? Maybe I may be a victim of some type of, fraud. So I think for everyone, if you just remember that, it may reduce your exposure, to be honest with you, because if you watch the news, people who are often victims have mostly been people who've been sold a dream of an opportunity where it's very low risk. And I'm going to make you 80% return in 6 months or 12 months. That's practically almost impossible. So when you listen to something like that, and it sounds like low risk, the first thing you want to see, is it low returns? If it's high returns, and like, oh, wait a minute, something is not good with this math. So
something hasn't been straightened out.
The math, like the young people say, the math is not math.
Exactly. I like that you put it like that too, because for young people too, we a lot of times we get lost between the way older generations talk and the way we talk, right? We say the math is not math, and we understand what it means.
Exactly.
But the older generation says it more formally. They say, listen, something isn't right here. Yes. Something is clearly not going to say criminal, as you said, but something is at least not right. Something is questionable around here. Now, to a few, if you could give us a few takeaways from this recording today, what would you say is how to put it, a good mindset, a level-headed mindset to have for the individual investor who is beginning to get into investing or is looking to doing it, and they're looking at how to manage the amount of capital they're going to put in, and how that is going to affect them, the risk that it takes to them.
Right. I think there's a few important things, but one is, first of all, understand your liquidity risk, right? You don't want to put money in something and then a few months or a few weeks later, you have to borrow money from somebody else. Or you're having a difficult time trying to convert whatever asset you invested in into cash for some short-term needs. I think we make that mistake a lot. That's why, there was a certain time where there's a lot of, I'm going to say this with no shade at all. There's a lot of people that were investing in crypto that also call their family and say, can I borrow $1,000? I have all my money in crypto.
Yes.
I'm like, you did not consider your liquidity risk at all?
I know people just like that.
Yeah. Or people who invest in real estate and like, man, I just put all my money into this property and can I borrow money until, like, wait a minute, you're not considering your liquidity risk at all. And so now What they don't realize is they are incurring a high cost of that investment because now you have to borrow money if you're lucky enough or get a loan at a higher interest rate than your returns.
Yes.
Or the worst of all worse, use your credit cards, right? At 23% interest, which you know your investment will probably never make 23% returns for you. So now you've incurred a higher cost to maintain the liquidity that you need that you should have considered before you went into this investment vehicle. That's my message. Consider liquidity. Make sure you do passive investing to start. You don't have to be spending hours. Take your time to learn the lingo. And at the end, make sure the equation makes sense to you. Make sure the math is math and when someone speaks to you. If it's low risk, it should be low reward. If it's high risk, it should probably high returns. And sometimes if you get lucky, but that's not the norm. And you should just know. Think of those things. 90% of individual stock picking day traders, 90% of them never beat the market over a long period of time. Maybe in the short term, maybe this month they do well, maybe the next month they do well, but over a long period of time, they do not beat the market. That's what I have to say.
Well, Yinka, thank you. Thank you so much for your time here today. Thank you for imparting this knowledge onto us about risks and rewards, ROIs, and the key takeaways that you just gave, the message you just gave for our viewers, for our audience. And to our audience out there, thank you for tuning in to this episode Between Bears and Bulls. We, as you've already heard, this episode was mostly focused on investment risks as well as the rewards you can get out of that. I invite you wholeheartedly to watch this, and we'll see you next time. Thank you.
Thank you.